So today we are going to discuss about ESOP. So we had one detailed seminar, which was on what are the taxation implications as far as ESOP is concerned. So today, what I'm going to more focus on are this is the agenda. There, we are going to discuss new software tools which have, new ESOP instruments which have come up. So I'm using the word ESOP instruments because there are multiple new ways of giving ESOPs to employees, senior executives, etc. So that's what we are going to discuss. What are the new instruments which are there? Number two is how to plan ESOPs. Okay, so that's what we are going to discuss, because what happens is many a times we know that the ESOP is a very good tool, but what happens is how to plan it, how do we give this ESOPs is always a question mark. So therefore, we are going to discuss on that side. C is what are the ESOP policies which one should look after so that there is no backfire, and then how this can be rooted through a trust model and the legal consequences of this. So this is going to be a power pack presentation, which is going to be discussed upon how this ESOPs can be actually implemented, and just not being a part of strategy, but actually implementing this ESOP policy is what we are going to discuss today. So first, a very short brief about, we all are aware of ESOPs, sweat equity, etc. But some very important part of it is that ESOPs which are not provided for independent directors, employees or promoters, and people who are holding more than 10% shares. When we go to sweat, basically sweat equity is generally issued to the people whom we are trying to acquire some IPR or some talents, etc. When we are hiring some talents or we are acquiring some talents, that's where we give sweat equity, because sweat equity is an immediate instrument which is getting transferred, whereas ESOP is based on certain conditions getting satisfied, right? So therefore, what we say is basically there should be an internal transactions between the business for more than 1 year. Locking period in sweat equity is 3 years, whereas in ESOP is as per the plan. ESOPs basically valuations in both the situation, valuations are done by registered valuer. If it is a listed company, then of course the values are available. So there's no need to do a separate valuation. But in case of private companies, basically registered valuer does the valuation of this. When we go to certain restrictions under sweat equity, 15% of the paid up capital, that's one of the restriction. In here, you can't give more than 15% of the paid up capital as sweat equity. And or the issue should not be more than 5 crore. And overall limit is basically 25%. So year on year basis, you can give not more than 15% of 5 crores, but on an on the overall basis, you cannot give more than 25%. Taxation basically is ESOPs is on the exercise which we all are aware of, and when you look on to the sweat equity, basically it is taxed as salary. This is another tool which is used to remunerate and to retain the talents, which is basically community stock option plan. So community stock option plan, when we look into this thing, there are different terminologies. One terminology is MSOP, TSOPs. Okay, so TSOPs, MSOPs, these are all the varieties or variations of ESOPs. So when we talk about ESOPs, it is employee stock option plan. When we talk about MSOPs, it is merchant stock option plan. When we talk about TSOPs, it is basically teachers stock option plan. Okay, and so forth. But these are all the characteristics of all these things is basically coming out, or it is getting generated from the root, which is basically ESOP, right? When we talk about community stock option plan, what is this community stock option is similar to a crowdfunding. So I'll just make it a normal thing that what does this mean? But this means that when you're looking out for a crowdfunding investment, so generally this community stock option plan is issued. We'll be discussing in detail about it, but I'm just giving you the background of it. Okay, so now when we look into it, what are the differences which are there? So this is an important slide where where I've just tried to summarize what are the important things now when we do the comparison. So if you see at the top, the two important differences are, one is it is share payment, where basically in case of ESOPs, MSOPs, sweat equity, all these situations, shares are actually issued. Okay. When you go on non-share payments, so basically non-share payments includes your phantom shares, your SAR, and so forth, right? There, what is happening is the shares are not getting issued. Only the price difference is something which is getting remunerated. Now, I'll tell you in one particular format of an example. So in MSOP, TSOPs, ESOPs, what is happening? Basically, there is a commitment from the company that I will be issuing certain number of equity shares to you in case if you are able to satisfy certain vesting conditions, right? Over a period of time, the shares are getting issued, right? Vesting happens, vesting then exercise happens, and through exercise, the shares are getting issued. So that's basically share payment transactions, right? Now, when I go on to phantom shares, when I go on to SAR, when I go into NSOP, so these are all the elements, characteristics of this is basically where today I'm giving a commitment that certain number of price at which you are buying it, the rights, okay? And when it reaches to certain number of level, okay, the difference of this is going to be paid to you, right? So you are getting remunerated, but you're not getting paid, you're not getting shares, you're getting the differential valuations as the remuneration. That's what is non-share payment, right? Now this is a chart which is going to talk about what are the differences. So if you see on exercise, some red ones is what I'm going to talk about. The first one I spoke. The second is cash flow, so there is no outflow at the initial stage. Shares are issued. On the other side, when we talk about non-shares, basically at the time of exercise, this particular payment is going to happen. To whom it is issued? So on the first element, if you see, all the ESOPs, etc., are issued to employees, directors. MSOPs, TSOPs are issued to that respective category. When we go on to non-share payment, basically it is issued to vendors. So phantom shares are basically very popular for vendors. So if suppose a distributor or a manufacturer who has been into the business since many years, okay, they have a set vendors whom they have a very strong relationship. Okay, vendor is not doubting the capability and the growth story of the company. In that situation, phantom shares would play a very important role. MSOPs can play a very important role because there, in case if the company doesn't want to get into the liquidity problem, or in case if the commitment company is intending to have a commitment from the vendors, right? In that case, this instrument can play a role. For example, if I am the person, I am a vendor for ABC company, and I am very strong, very clear that this company is doing very good in business. They are ethically very good as far as payment terms are concerned, and they are growing company. Now, in a growing company, which is regular in payment, which vendor would not be interested in investing into it, right? Everybody would be interested. Now, from the ABC side, what are they looking out for? That this vendor is giving me a dedicated preference, right? My materials are getting manufactured at the right time, or my services are provided at the right time. So that's something which ABC is looking out from me. So this is going to be a barter of expectations, and therefore this particular instrument, MSOP, TSOPs, etc., are playing phantom shares, etc., are playing a very important role. Same is the consultants. So all these consultants like us, like you, or like people who are there in and around who are into service industry, for them also this phantom shares plays very important role. For startups also phantom shares plays a very important role. The benefit of phantom share is or non-share payment is that you are not getting into dilution of your equity. The equity still remains with the company, with the owner of the company. What is getting diluted is the commitment that in case if the value of the company gets higher, you will be paid the differential amount, right? That's the whole concept. Now we go to the next. The next point which I'm going to touch base upon is how is this going to plan? How do we plan it? So we have spoken about many a times about ESOP, right? Employee. And more importantly, private limited companies. So private limited companies, I'm using this word that there is a myth that today listed companies can give equity ESOPs, but private limited company, how can they give ESOPs? But that's not true in today's world. Why? Because if let's say I'm aligned with the company's goal. I'm talking about with the people whom we know that they are understanding what is the business plan, what is the vision of the company, etc. See, people, there are three categories of people. One category of people who just move from one job to another job. Okay, so that's not the category of people whom I'm talking about. The second category of people are the one who are very talented, okay, but they are not, they have not understood the vision of the company because there is a hierarchy. So that second category of people are somebody whom the company wants to retain. So they can be retained not by business vision, etc., but they can be retained with tenure, that I'll be giving you this much number of tenures. Okay, so if you stay for 3 years, you will be get this much number of equity. If you get, let's say, stay for another fourth year, if you stay for sixth year, then this is going to be the equity which you will be getting. Now, somebody would ask why an employee would be agreeing to it. So, employee would be agreeing to it provided number one, there is a good culture in the organization. Number two, they are able to see that the company is able to make the salary payments on time. They are able to see that the customers, the stakeholders, different stakeholders are satisfied with the company, etc., etc., etc. So, again, giving the same point that employee are also interested to be with the organizations which is growing and which is on time payment company, right? So there, even employee is also getting an opportunity that okay, I'm getting ESOPs because of this reason. So that is one way of retaining the talent. Third category, we started with three categories of people. So one is the people who are just shifting the job. So that's not the one. Second is the one we spoke about. And third is the people who are the engine of the growth engine. Now, these people are actually the pioneers or the pillars of the vision, mission, business plan, strategic plans, etc. of the company. So they are getting associated with the performance base. So I'm just taking one example over here and explain the point. The point is that let's say if suppose a particular company has decided that I want to expand in the span of next 5 years, next 7 years. Example, I'm just giving as an example. It could be 3 years as is mentioned in this case. So I have made a plan that 15 cities is what my marketing head should be able to reach to. New 15 cities should be opened as a business. New 20 cities should be opened as a business. New 25 cities should be opened in third year. Now, this is a plan. And therefore, my marketing manager is being committed. I am committed as a company that year one, if you're getting 15, you'll be getting 200 ESOPs. Okay. Year two, you will be getting 300 ESOPs. Year three, you'll be getting 500 ESOPs. Now, somewhere or the other, these ESOPs are in connection with what ideally I would have paid as a compensation to him, as a performance compensation. Okay. So somewhere I'm connecting it with that. The major difference is that there is no cash outflow in year one. The cash outflow will be once the conditions are satisfied. Now you will say that why the employee would do? The answer is the employee will be doing it because he is able to see some valuation growth. Okay. So that is, it's like a property purchased where I'm not looking out only for rental yield, but I'm also looking out for appreciation in the property. Same is the concept over here, that I'm not looking out only for salary, but I'm also getting benefited for the yield which I'm going to get as a valuation in the business, right? So therefore, a marketing manager says that, okay, I'm agreeing to it. I will be ready to do it. And these are the equity options which you have provided, and I'll be buying that particular point. Now, the second situation could be the operational manager. Now, operational manager has been given a commitment that in case if you ensure that, let's say this is I'm just taking as an example of a travel company and a giant travel organization who is looking out for ticket bookings. Okay. Now, the major challenge in the travel business, which we have noticed, is that you get the inquiry, but it finally doesn't get converted to booking, and the revenue is of course connected with the bookings. So, in case if suppose at that point of time, I have decided that if you are able to do 10 lakh bookings a year, 200 ESOPs, if you're going 15 lakh, and respectively, what is there in the screen. So if you are able to do that, I am committed to give you this number of ESOPs. And that's how the operational manager is looped in or onboarded with a vision, mission of the company, right? As in the third one, as we are seeing, it's the number of years. So for example, any manager who are there with the company for, let's say, 3 years, 5 years, etc., i will be I will be retaining him with this particular saying that, okay, first year if you be there, third year if you be there, sixth year if you be there, then this is the something ESOPs which I'll be providing. Now, this is the plan. So what I've just, as I was saying at the initial stage, how an ESOP can be planned by a private limited company, this is how it can be planned. Now, the next question will be, why will employee be agreeing to it at the valuation? So today, this was the story, and this was a question which I would have agreed if it is 5 years back, okay, or 4 years back, or maybe pre-COVID example I'm talking about, or somewhere on that side, where the era of private limited companies valuations were always in question mark and it was subjective. However, if I talk about today that's not the case. Today, if you talk about any industry, any sector, any business, okay, one can at least give you a broad idea about what multiple it is functioning with. Okay, so if I talk about example, a retail business, and let's say, I just as an hypothetical example, I'm saying that let's say a retail business with 10 multiples is working right now, example. Okay, so 10 multiples is a valuation which is with the pat, 10 multiple is working. So let's say 10 multiple pat is something which is a valuation. Now if there is certain areas where you want to negotiate and you want to reach to certain stage, of course that can be done, but that can be a multiple which is an industry, which is a business multiple. Now that can act as a valuation for you, and that is something which is accepted at the time of the grant. So while I'm giving the grant, I'm agreeing to it that, okay, I will give 5 multiple, I'll give 3 multiple, I'll give 10 multiple, whatever multiple I want to connect it, adjusting it with the compensation which I want to pay. Now that's how I will work out the compensation which I am supposed to pay to my employees, and at a reverse level, I will work out how many ESOPs I want to issue, right? And also, I'm bringing up a point that valuation is not under question mark or it's not under subjectivity, but it is objectively defined that this is how I'm going to arrive at it, right? So that's about the plan. I'm moving to the next part of the agenda. The next part is basically drafting an effective ESOP policy. So these are some of the points which are there, like the tenure, the performance, which is the eligibility criteria. Once the ESOPs is designed, the scheme is designed, it is the approval where the board will approve it, your shareholders would approve it, your employees will approve it, right? So whoever are the stakeholders related to it, they are going to approve this particular plan. So that's number two. Number three is vesting conditions. So what are my vesting conditions? Should be categorically be very clear, very well planned also, because in case if you have failed in good planning, then it may so happen that the end of the day, company whether makes a profit or not, whether company has the liquidity or not, but the employee may get benefit of that. Or vice versa, company is making very good profit, company is having good liquidity, but at the end of the day, employees are not getting the benefit which otherwise they should have got. Now that's the play which should not happen at later stage, and therefore it should be well planned. Exercise is basically when you're exercising, in case if your ESOPs etc., you have a model which in based on which you can arrive at the exercise valuation, that what should be the price, exercise price, right? What it should be the fair market price at that particular time, and therefore that's the difference. So for example, the exercise price is 500 rupees. I'm sorry, if the fair price is 500 rupees at that point of time when I'm going to exercise it, 500 rupees, and let's say at that point of time the exercise price which I wanted the employee to pay to me, let's say is 200 rupees. So the difference is 300 rupees, which is the cost for the company, right? Which will be allocated into the books over a period of years. So that is something which is important to bring it up, that exercise price is something which can be envisaged, which can be worked out, which can be valued, right? And that's the scientific methodology to arrive at it. Period, of course, what is the period which we want to allot for? Locking period, which is also important, that in case if I want to have a locking period for it, then I need to define it very well. It should be strategically decided what should be the locking period which I want to have. So all this is something which should be a part of the policy. What can be backfire points? How can it be backfire? Okay. So these are some of the things and how we safeguard. See, backfire is one element, but how do we safeguard it? Because that's also very equally important. Now, the safeguarding of this particular thing will be that, let's say if suppose you are an employee. Okay. Now, what are the ways in which you can be safeguarded? So first is reverse vesting. Okay. So there can be a clause in the grant where you are very clear, and in the scheme where you're clearly mentioning what are the situations in which it can be reversed vested. Okay. So unvested shares will be forfeited. Partial vestings, let's say if suppose certain shares have already vested. So just as an example, if I'm talking about this particular situation, 10 lakhs achieved, he got this number of shares, 15 lakh don't need not achieved, 20 lakhs not achieved. In that case, your partial vesting will happen, but balance vesting will get forfeited. Right. So that could be one of the ways of controlling it. Clawback, wherein you are, because it's not been performed, you are clawing it back and you are stopping the scheme. So that could be one situation. Hybrid vesting is also one option where it is a combination of ESOPs plus performance bonus. Combination can work. Second ESOP grant plan. So let's say if suppose one plan you are seeing that the performance is good, you again get into another plan, you again get into the third plan, you again get into the fourth plan. So what you are doing is you are attracting the talent and asking the talent to continue so that we grow and you also grow. So that's something which could be there. Cash outflow. So in case if suppose there can be a question which is to safeguard the employee. Let's say the value which we propose, or while we had granted. Okay, there was certain valuation which were expected. However, we could not reach to that particular valuation. Let's say, for example, we could not reach. Now, in that particular case, if I am not able to reach to that particular valuation as a company, employee will get demotivated. बोले बॉस बड़ी बड़ी बातें आपने की थी जब भी हमने ग्रांट दिया था, बट अभी जब भी हम देने लेने के लिए बैठे हुए तो आप बोल रहे हो कि आपका प्लान नहीं फंक्शन किया, आपका ये नहीं हुआ, वो नहीं हुआ, एक्सेट्रा एक्सेट्रा एक्सेट्रा. That can be the thought process which an employee might be thinking about. But when I talk about from the company perspective, company is thinking, no, though we have not achieved at the speed at which we should have achieved it, but still I'm seeing a what do you say, cream in on the cake, right? We are able to see that the plan will work, and therefore I still want my people to retain and don't want to demotivate that. In that particular case, this can be an option which is available, wherein you can give an option of encashing at a particular value, and that can be predefined in the grant, right? Leadership perks can also be an option, which is mainly to generate and develop the second line command. So these are the multiple options which can be worked upon. Ways safeguarding employees. Okay, how can we safeguard them? So define clear ties. Okay, so generally it is also seen that in case if it is imbalance, okay, then what happens is people are not that there is a split in the culture of the organization. So therefore that also needs to be safeguarded, and therefore this can be a role which can play clear tiers. Okay, wherein it's very clearly defined and rightly classified to avoid imbalance in the culture of the organization. Performance link, that is an option, so that it's very clear if you achieve the performance, this is the incentive which we are going to get upon. Non-equity rewards is basically the one which is non-share payments. That can be an option where the equity is not getting diluted, however the employees are getting remunerated. Okay, so we are done with that part. Now I'm moving to the next point, which is trust route for issuing ESOPs. I basically in this case, when you're looking out from the trust route perspective, okay, how can we do that? So first, let's understand that for a private limited company, why would a trust route play an important role? Why can't I directly issue ESOPs? Okay, or when do I have this trust route? That's something. Let's deliberate that, and then we come to this particular point. So the first thing first is basically when you are having a group of people and relatively a large group of people in the organization, and you have multiple branch of companies, okay, maybe subsidiaries, step down subsidiaries, etc., etc., and you want to have a plan which is centrally organized. So therefore then that case trust can play an important model to manage and administer the whole thing, right? So that's one. Number two is basically where you want to buy back. Okay, now in a private limited company, because it is not available on open market, so therefore, if in case if you want to buy back, then the buyback policy will affect the company's overall ownership structure, and therefore trust route can play a role where the trust can do a buyback of the shares and the employees can get remunerated for that. So that's the reason why this can play a role. So having understood it, that why a private limited company can go for a trust route, let's understand how the trust route is going to function. And this is very important because it allows us to understand how the flow is. The flow is this, where there's a trust, which is an employee trust, which is a private trust, and the private trust needs to be registered, should be formed with the registered deed, right? With a clear objective defined over there. So the point number one will be that the grant of loan will be. So I'm just, these are the numbers, right? So this is how the sequence will play a role. So number one is grant of loan for payment of subscription. So company will grant money to a trust. So there will be a there will be a setting of a trust, and trust will get the money from the company, which is by way of a loan. Okay. Now that particular fund is going to be there with the company. Number two is basically the trust will buy the shares of the company. Okay. So under the trust balance sheet, there will be a liability uh, for the company. And on the other side, the trust will take the shares of the company. Okay. On the asset side. Number three is where the exercise is happening. So the time when the exercise is happening, at that point of time, trust will take the exercise money from the employees, right? And trust will issue the shares to the employees. So it's an option which are issued to the employees, right? Trust got the money, so that money will be utilized to repay the loan which the trust has taken from the company. So that's how this transaction will be routed, and ultimately the whole transaction will get completed. So that's the model which is just described it over here, and that's how it will play a role. Now, I have just spoken about this. Why will a private limited company for look out for a trust model for issuing the ESOPs? What are the compliances which are required? Now let's go on to that fact. The compliances are ROC. So these are multiple things which will have to be done. Board approval will be required. Remunerative committee will approve it. Shareholder meeting will be there where it would be the scheme would get approved. Employee will be approving it, and then the trust will be set up. Let's say if we are having a trust, the trust will be set up, and trust will be based on the deed, which is going to describe all the terms and conditions on how the scheme will have to be operated. Mind you, we are all aware about the fact that a trust can have multiple employee schemes, right? So the administration of the trust can manage multiple schemes which is designed for the group of people. Now why multiple schemes is required? Because see, there are different set of agendas with the employees. Okay, for different class of employees I have different agendas, and for different agendas if I want to cater them, then I need to have different schemes for them. I can't have one scheme applying one particular line of scheme for every people, because that will absolutely ruin the whole culture of the organization, and therefore this particular multiple levels of scheme can be there. And for that, the management of trust and administration of schemes, for that the trust can play an important role. What are the ROC compliances I have mentioned? ROC compliance I'm done. PAN number is something which is required. Valuation report is required from a registered valuer, as we started, was there in the second slide. Loan to the trust. So in case if suppose the trust has the company has a liquidity issue, there have been situations where trust have taken loan from the banks or from the financial institutions in order to buy the shares either from the open market or buy it from the company, and then lend it to the employees, right? uh, Shares allotment, so there will be allotments will happen, transfer to the employees, right? And loan repayment, this is something which we discussed. Trust is something which I just spoke about, and we need to ensure that it is a registered trust and the trust is getting registered, and it is governed and it is operated under the Trust Act. Some questions which people would be interested in knowing about is basically, from the ESOP's taxation perspective. So tax deductibility, when will it be allowed as a deduction? So now there are series of cases where it has been mentioned that the date on which you have granted the shares, you have allocated the shares over the period of time. It will not be a contingent liability, because revenue as a tax office were trying to argue that this is a contingent liability, because at the end of the day, the shares might get issued or might not get issued because of non-performance. But there have been series of cases where it has been concluded that this is going to be not a contingent liability, it's an ascertained liability, right? And the liability is booked on a proportionate basis, and therefore the expense will also be allowed on a proportionate basis. Question number two is TDS. Yes, no, TDS will have to be deducted when it is exercised, because that will be considered as salary, and therefore the TDS will be deducted at that point of time. Taxation on trust route. So basically, trust is playing a fiduciary role, so therefore, it is not having any taxation element. However, company basically, as we have spoken, that they will create a reserve, okay, where the expenses will get booked, and ultimately it will get set off against the equities which have been issued. So that's how the transaction will be routed from the trust place, and from the taxation perspective, because trust is playing a fiduciary role, therefore there won't be any taxation for the trust. However, company is issuing, so it will be claiming as an expenses, and employee is receiving, therefore it will be offering that as a tax, right? Valuation. So we have just spoken about that while you're giving a grant, you are doing a valuation of the fair market price, and therefore that is done by a registered valuer. If it's a listed share, the price is available, and if it's an unlisted shares, at the time of exercise, merchant banker will do the valuation at that point of time, and whatever is the value at that point of time, that will be considered for the purpose of taxation. In case if it's a private trust, I'm not talking about the listed company. Listed company, the price is available. If it is a private company, in that case, merchant banker will do the valuation at the fair price at the time of exercise. Whatever is the fair price defined by the merchant banker minus whatever is the exercise price, that is the taxation which the employee will have to pay. And as far as the company is concerned, that will get the deduction. Okay, I think I'm done with my presentation, largely because with the given time, I just wanted to cover all the points which are there. Since we have some more time, what I will be doing is I'll be just recapping in case if certain things additionally I want to bring it up to your notice, and which could be helpful. But by the time we move out, this is something which is basically a screen which is having a QR code. This is one group which everybody of us, there are a lot of chartered accountants, approximately, if I'm not wrong, around 800, 900 chartered accountants, lawyers, etc., who are just helping each other in solving the queries. The group is having no nonsenses. The group is only for ensuring that all the queries somewhere are posted, and there is somebody who have experienced it, and he'll be able to share that answer. And it is not my personal group, this is a group which is already available. I'm just mentioning that in case if people wants to take the benefit, they can take the scan of QR and become a part of this particular group. uh, just pausing it for maybe 2 3 seconds, and then we just identify if there are some things more to discuss, and then in case not, then we'll be just taking question answers which are already there, because there are many questions which are already there on the screen, and I'm sure there can be more questions which can be there. So I'll just would like to get more into question answer format and take that particular thing, right? Yeah, coming back. Okay. So this is one thing where I would try to spend more time, because the time is available. So I'll spend more time on this particular slide, where I would just like to share with you my experience, which I'm seeing how this world is evolving, or maybe not. I'm talking about world, but let me talk about more of our country, where we are seeing there's a lot of things which are getting evolved over here. A lot of new instruments are coming in, and then with the startups and also now a private company. So See, listed companies were always into ESOPs. Okay. Startups also are into ESOPs. But there are new instruments which the startups are coming in. And that is something very interesting to understand for us as a maybe the business owners or maybe the consultants. So that is where I would like to spend some more time. Now, let's say a particular company is looking out for crowdfunding. I'm saying when saying crowdfunding, I'm just trying to mention that there's a company is looking out for investments, and at the stage, company is looking out for investments from different people. Now, how will I get an investment from different people, and how will I give equity to each one of them? Let's, for example, somebody contributing 10 lakh rupees, somebody contributing 50 lakh rupees, somebody contributing a crore of rupees as an investments for the company. I'm talking about the seed funding, or I'm talking about the second level funding. Okay. Now, in that particular case, this instrument, which is basically community stock option plan. Now, here what happens is people will come over here. Just give me 1 second, please.
Uh, Excuse me, sir, you are on mute, so you might not be audible.
I'm sorry. I'm sorry. I'm really very
It's
sorry. I'll just repeat the point. The point was that stock option in the community plan, investors will come in. Investors will be making investments in my company. I'm into a non-share payment model. So under a non-share payment model, I will be making a further commitment to the investors that you are entering into an X price. The funds are going to be invest into the business plan. It will be executed, and ultimately the return will be shared back to the investors. And that's how the community model is working. Now, this is an innovative way of getting crowdfund as an investment, right? Now, in this situation, the question will be that there will be multiple people who will be investing into it. So, what will happen is there will be one particular agreement which will be prepared, and that agreement will be a binding agreement on the company, wherein they will be ensuring that all these people who are investing into the company, that particular company is entering in the my company, and that investors are entering into a binding agreement for a community stock option. So this is one instrument which is working. MSOP, as I spoke, when I'm a distributor, I'm a manufacturer, or I am basically a infrastructure contract provider or maybe a contractor, and my merchant relationships with the vendors are very good. I'm very good in payment terms. I'm seeing that I have huge of number of projects, or I have huge number of orders. I'm growing company. So in that case, I'll be issuing MSOP. Okay. Now under MSOP, merchandisers or the vendors, they will be investing not by way of equity, but they will be invested by way of commitment. They can be also investing by way of equity, wherein whatever price we have agreed upon, they will not be paying a full price. I'll be not be paying full price to them, but my arrangement will be there that I'll be paying you X price, and whatever is the differential where I am entering into a commitment where I will be issuing you my MSOPs. Against those MSOPs, basically they'll be getting equity. It could be a share-based payment. It can be a non-share based payment. And that particular way, when my company is growing, whatever valuation we are arriving at, that valuation is what the merchandiser or the vendor will be getting the benefit of. So he is in a way investing into my company. He is also getting aligned with my company, and therefore he is getting committed with my company, right? This can also be with the distributors, where distributors are getting aligned with my company, right? And now you can extend the story for your business relationship wherever would you like to. And that's how this particular model is working. In case of startups, we are seeing that startups are either giving sweat equity, they are giving phantom shares, or they are giving this particular stock options, TSOPs, MSOPs, etc. Now, here also, it's the same philosophy which is getting applied, and people are taking the benefits, startups are taking the benefits of that, right? Uh, this is something which I just wanted to communicate. Now there are around 16 questions which are there in the chat box. So I'll just take each questions because and let me just answer those. Uh, what is the difference between SAR and phantom shares? Okay, so basically SAR is an instrument which is generally issued by listed companies, wherein there is a regulation. It is governed by the regulations, and as per the regulations, the SAR plays a very important role. So SAR is largely governed by regulations, is what I would say. Phantoms are basically where private limited companies are also issuing it. So by nature, the difference is not there, but by application, this is one difference. The second difference is that SARs are also largely, I'm talking from a practical standpoint. SARs are mainly issued for employees, and phantoms are basically issued prior to vendors or consultants. So that is one difference which is there. The third difference is basically, I'll just take this point. So if you see this slide, it is mentioned over here that when you are on SAR, mostly shares are basically at the because it's a listed company, so the price are readily available. So there's a difference of price where this transaction happens. When it comes to phantom shares, there is some valuation role which need valuation plays one role. So there's if you're not objectively defining it, then it is subjective. So therefore, that is as far as SAR is concerned, it's completely objective because it's very well linked with the market. Whereas in the phantoms, you need to objectively define it, right? So that's two major difference. In case of phantom, okay, one more important thing under SAR, because it is if it is issued to employees, then it is under taxable under the head salaries. Whereas if you talk about phantom shares, because you are issuing to the vendors, it can be a perquisite, and therefore it is a business income. So that is one more difference which I just wanted to bring it up. Okay, next is, can phantom shares or shares be independent, can be issued to the independent directors? So basically, uh, I need to come back to this particular answer. We need to get into this particular point separately. You can share with me this question separately, and I'll be answering this particular question. Next is, what about capital gains in the hands of trust or transfer of shares by the trust to the employees? So basically, here, see, if you see this transaction, the trust is basically playing a fiduciary role. Okay. So therefore, there is no capital gain tax over here because at the end of the day, the trust is only playing a important fiduciary role. However, if you let's say talk about the case where trust is getting the shares. So basically, what is happening is trust is buying the shares at 20 rupees. Okay, let's say I'm talking as an example that the price at which this is going to be exercised is 20 rupees. So trust, what will be doing? They will be buying the shares or subscribing the shares from the company at 20 rupees, and they will also be issuing the shares to the employees at 20 rupees. So what is going to happen? Employee is going to pay 20 rupees to the trust. Trust is going to pay this 20 rupees to the company. So at the end of the day, trust is at the nil position. So that's one thing because of which there cannot be a capital gain. And secondly is because it is playing a fiduciary role. That's one of the important principal point to keep in mind. What about the next point is, will the trust purchase the shares from the company would it be at the full price? If in those cases, will the ESOP cost be recorded and the company or the trust? So basically, in my opinion, the trust will be buying this particular shares at the exercise price, and therefore, whatever is the price at which trust is buying is this. Company is going to book this as a reserves, employee reserves on a regular basis, and ultimately, when it is going to be exercised, at that point of time, shares are going to be issued, and that is going to be knocked off, right? Now, how are RSU different from ESOP? So basically, there is no major difference. In terms of conditions, there can be a difference, but otherwise, there is no major difference. Okay. The next question is, are merchant banker valuation relevant in today's scenario? Answer is yes, it is relevant, and that plays an important role. Are phantom shares subject to any regulations? If not, where does it derive the legitimate form? So basically, it is by way of a contractual agreement where the phantom shares are agreed upon, and therefore the Contract Act would play an important role. Secondly, I would also say that generally this kind of things happens when the company is clean, company is growing, and there is a brand which is getting developed over there. So when I say brand, I does not mean brand as such. What I mean is basically there is some level of trust on the company. Okay, so therefore, at that point of time, and in that situation, let's say as a consultant, I will agree to to take the phantom shares against my consulting services. Okay, so that's one. B is, to answer your question legally, this is basically this is governed by the Contract Act. One of the startup company is inquiring for ESOP pool from promoters, shareholding before the investors come in. How it will be designed for ESOPs for future employees. So basically, there so I'll just repeat this question. The question is that one of the startup companies inquiring for an ESOP pool, okay, from the promoters shareholding, right, before the investors coming, and how it will be designed for ESOPs for future employees. So basically, here what is happening is that the scheme, which is mentioned, is well approved by the shareholder. When an investor is coming in, so there is one clause also which can be mentioned in the scheme, which can be to adjust the commercial understandings which the investor is having. Okay, but and therefore that particular clause can play a role when the investor is coming in. So I'll just take an example. Let's say a ABC company today have no investors. It's promoter driven company, and they want to commit for ESOPs, so that ESOPs are getting committed as a scheme. But there can be a clause in the scheme which will mention that this will be subject to certain level of adjustments, okay, which an investor will be looking out for, and that adjustments will have to be binding on both the parties. That is number one. Number two, in case if you want to be commercially open for not affecting to the employee in terms of any kind of benefit which they should be receiving, that can be adjusted by way of cash outflow, okay, wherein they are not getting affected. However, your investors commercials can get adjusted. So that's how it can be managed. In community stock option, if the company is not in a position to pay back. So basically, in case if the company is not in the position to pay back, then basically that is the breach of the contract. And the contractual agreement will be clearly mentioning this particular point as to what should be happening in that situation. Okay. Largely on a practical sense, if I talk about basically being a startup world, okay, in case if it is not functioning, let's say today also, in case if the idea on which the company is working, okay, if that, see, any investor when he's investing into startup, he's investing not on startup, he's investing on two things. One is the idea, so the investor is having a conviction on that idea, okay, and second is the investor is investing on the entrepreneur or the promoter of the startup. Okay, now even today, if I am investing into the startup as an equity holder and the idea is not working, that startup idea is not working. Okay. In that case, I don't get anything out of that. Right. In case if that idea is going to work or it is working, then I'm getting a valuation out of that. So that's the bet which I'm doing as an investor. I'm taking that bet that if this idea worked out, I'll be benefited. If this idea didn't work out, I'll not be benefited. That's the commercial understanding which an investor has when he is investing into the company on a startup company. The same logic is applied over here. That investor is investing on that basis. If the idea is working, then I'm getting benefit. If the idea is not working, I'm not getting the benefit. That's the simple rule which is getting applied, right? Next question is, in case of a CSOP or MSOP, whenever any allotment wishes to exit, allotee wishes to exit, does CSOP or MSOP agreements needs to be altered? Answer is no, it is not required because it is well defined in the beginning itself, and that's how it will function. Next question is, what is the major difference between ESOPs and RSU? I think that's the same thing which I answered before. No major difference. There can be certain restriction. Okay. And therefore, let's say if an employee scheme is working. Okay. There's one employee scheme which is working. Okay. Now there's another scheme which you want to bring it up, which is aligned to this particular scheme. So somewhere this scheme is working. There's an alignment to this particular scheme, but you want to have certain restrictions. Okay. So then at that point of time, also this RSU can play a role. Okay. So that's the application of it. You can make an application of it. Next is CSOP similar to ESOP? So answer is it can be similar. It can be under a non-share payment mode. Okay, so both are there. Now, generally on practical front, it is non-share payment, which the CSOPs. So therefore, it is different. But can it be? Answer is yes, it can be. Now that depends upon how the company is arranging it. But now let me give you this point also, that when you are under a share payment mode, CSOP will require to issue the shares. Okay. And it is not conditional based, it is basically issued to the investors. However, in the employee stock options, you are issuing the share. Here, the whole objective of this instrument is that I'm not issuing the shares, I am getting into a commitment. Okay. If I'm issuing the shares, in that particular case, it is similar to an investor getting an equity against the investments which is making into the company. Now, I don't think there will be a situation where an investor would agree that I am investing into your company. I want an equity after a certain stage of time. So then that can be a debt instrument that I'm investing into the company by way of a debt with a particular conversion model like CCPS or something like that, wherein this particular shares are going to get converted into equity. So that instrument is already available. So therefore, this CSOP is more playing in a non-share payment mode, right? Now, there's one more example or a case study which is mentioned, which is a detailed case study. I'll just try to get the gist of it and then answer it in case if it is separately required to be dealt with because they have numbers mentioned. We'll take it separately. You can email me and I can reply it. I'll just word it out what it says. Trust today is buying 100 shares from a company at 10 rupees and take a loan from the company for 1,000 rupees. In future, if it will issue shares to employ, let's say 25 shares, etc., it will receive total this much. There is a loan repayment of loan of 1,000. What is the additional amount of this much? I think I will have to take this question separately. Please mail me this question, Naman. I will like to answer this question on email because there's numbers which you have tried to mention, and I'll have to answer that numbers separately. Please email me. I'll come back to you on this point. What are the compliances for creating an ESOP pool? So I've just dealt with that question in my slide, wherein there are list of compliances will have to be taken off, and that compliances is equivalent for an ESOP pool. In case of phantom shares, as there is no dilution, how does it get recorded in the balance sheet for issuing the shares? So it is not a balance sheet item. Basically, it's a commitment which I'm giving it to the consultant or the vendor. Okay, so there is no this is not a balance sheet item. This is off balance sheet item like a contract or like an agreement. What was cashless RSU permitted to be allowed allotted to non-employees under the old ODI regulations. Under the ODI regulations, whether this will have to be dealt or not, I'll have to check it separately. I can't answer offline, answer immediately. Please give me this particular question on email so that I can answer you. Uh, so basically, does ESOP entitles the holder to right or bonus like other normal shares? Answer is yes, it is there. It's like an equivalent to a shareholder. Once it is exercised, okay, you become an equivalent to a shareholder. With this, I think all the questions I have answered. I'm sorry for not answering certain questions, but I would like to answer that because those questions were little detailed deliberations which is required. Therefore, I would just ask you to please email me so that I can answer those questions also. With this, on time, we are at 5:59 and done with the presentation and question and answers. I would thank you everybody for having this particular hearing, and would be happy to take more lectures on ESOPs and this, because that's my favorite subject and I enjoy to deal with this particular subject. Now, with again to the participants, this is the group where people can join to this group and they can participate by raising questions or clearing the questions of lot of people who are there on this particular group. I'm repeatingly, it is not my group, not my personal group. This is the group which is commonly available for all the people to raise the questions and get the answers for the questions if possible. And it's a no nonsense group, right?